real estate investment, reverse mortgages. Get ready because it's time to raise the stakes with real estate. Reverse mortgages, referencing Investopedia, a place you can go to do further research with terms and definitions that are investment related. So the reverse mortgages, a homeowner who is 62 or older and has a significant amount of equity in the home equity can possibly borrow against the value of their home and receive funds as a lump sum, fixed monthly payment, or line of credit. So general idea being here is if you're in a point of retirement, oftentimes people have a lot of the value, their asset portfolio value, their investment in the home, often having a significant amount of equity in the home at that point in time, meaning they have a value in the home higher than the loan amount against the home, and therefore a significant amount of equity. However, of course, the home is not a very liquid thing. You can't really spend the equity in the home very easily in order to pay for your current costs, especially at the point of retirement if you don't have other kind of income sources at that point. So then the question is, well, how can you access the equity in the home so that you can use that for your retirement as part of your retirement plan possibly, and do so to make that a liquid kind of component? That's kind of the idea of the reverse mortgage. Now you could structure the reverse mortgage basically in different ways. Basically, you're eating into the equity of the home. So in other words, instead of you paying off the loan, basically the bank is in essence paying you, having the value of the loan, the amount of the loan actually going up, which is going to be supported by the home. Whereas at the point in time at the end of this, then if the home was then sold, the thought being that you could basically pay off the loan and the interest that has compiled with the sale of the home. Now the structure or what the payment would be on the reverse could be like in the form of a lump sum or fixed monthly payments or a line of credit, right? And it would be dependent on the needs of the individual that wants the reverse mortgage. Do they need the lump sum money up front? Are they having a fixed monthly amount, which might be common if you're using it as part of a retirement kind of plan to have a fixed monthly payment with regards to it, or a line of credit, which can act as a safeguard so that you can kind of dip into it, basically borrowing money in essence, against the home as needed to safeguard in the event that you have a cash flow need at some point. So a reverse mortgage may not require the homeowner to make any loan payments. So again, instead there's still a loan against the home. Instead of you making the loan payments, then you possibly get paid from the bank, which would increase the loan amount, and then of course there'd be interest generally charged, you would think, on that as well. So instead the entire loan balance becomes due and payable when the borrower dies. So the idea being here, dies, moves away permanently, or sells the home. So at one of these major points in the future, possibly at death, right, because you're thinking about it in terms of a retirement plan, dipping into the equity as part of the retirement plan at the point of death, then the loan has been increasing, but hopefully the loan has not increased greater than the value in the home, and therefore you could sell the home at that point, paying off then the loan that has accrued and so on, and that would be how you'd work it out. So the federal regulations require lenders to structure the transaction in a way that the loan amount doesn't exceed the home's value, and the borrower or borrower's estate won't be held responsible for paying the difference in the loan balance does not become larger than the home value. So there's regulations saying, of course, that you can't basically make a loan, whereas at the point of death, you're thinking that the loan value is going to be higher than the value of the home. And obviously the institution itself, you would think, would not have an incentive to do that as well, because the whole idea being that they want to safeguard themselves. So you would think the loan would go up to some value that is going to be below what the expected home value is. Therefore, at the point of death, you could sell the home if that's what's determined to do in order to pay off the loan balance at that point in time. If the loan had gone above, the loan is now higher than the home value, then there would be a problem when you sell the home, right? And that could leave the estate in a problem at that point in time. So that'd be the general idea. Obviously, it's not a perfect thing to figure that out because the home prices may go up in value, may go down in value over time. And so what the valuation will be is kind of an estimate. So one way this could happen is through a drop in the home's market price. Now, obviously, if you set this thing up and then the market just drops in terms of the home value, then that's one situation where you might end up in a scenario where the loan balance is above what the actual home price could be. Hopefully, real estate being fairly stable, home values continue to go up, and then it would work out in itself. So another way is the borrower lives a long time. So obviously, if the borrower, if you use the equity in the home and you have standardized payments that are coming out, you're kind of using an actuarial calculation to see what those standardized payments would be. If you then have someone that lives a whole lot longer than they were expected to live, then the payments that they're receiving could result in the loan balance going up higher than you would have expected by the time of point of death. So reverse mortgages continued. They can provide much needed cash for seniors whose net worth is primarily tied up in the value of their home. So oftentimes many people's net worth, especially in certain areas of the country, depending on the value, the cost of the home, a lot of the money is tied up in the home. Problem being, the home is not a very liquid thing. You can't spend the money too easily, even though you've compiled all this equity within it. And so one way, again, to kind of get into that equity would be setting up something like a reverse mortgage. However, these loans can be costly and complex. So as we talked about, there could be kind of actuarial calculations, how much is going to be pulled out. You're kind of projecting what the future value of the loan will be. And then you've got to be thinking about, how much is going to be paid out, how the increase in the loan is going to be, and the interest that's going to be calculated on it, and simply the costs of setting it up can be a costly kind of component as well. So those things need to be taken into consideration with the reverse mortgage. So how a reverse mortgage works: instead of the homeowner making payments to the lender makes payments to the homeowner. So usually you make payments to the lender, to the bank, let's say. Now the lender, or let's say like the bank, is making payments to you. How can that possibly work? How can that, if I borrowed money, how can they be paying me? Well, basically they're extending you more and more of a loan, right? You're taking out more and more of a loan over time, which is being secured by the equity in the home, which the lender is comfortable with, given the fact that they believe the home is significantly higher value than the amount of the loan, and therefore at the point of death, with they're determining will happen at some point, given we only give these loans to people that are over a certain age level or something, then they would be able to sell the home and pay off the loan. And that's how you can basically tap into, in essence, the equity. So the homeowner gets to choose how to receive these payments and only pays interest on the proceeds received. The interest is rolled into the loan balance, so the homeowner doesn't pay anything up front. The homeowner will also keep the title to the home, so it's still the homeowner's home, right? They're not giving up the home, although obviously they're dipping into the equity. So remember, there's a difference between the loan, what the loan is, and what the home ownership is. However, obviously at some point in time, at the point of death, then the decision needs to be made: do we need to sell the home in order to pay off the loan that's going to be related to it? So over the loan's life, the homeowner's debt increases and home equity decreases. So that means you got the home. Hopefully the home continues to go up in value. The loan amount that the home is securing the loan, is supporting the loan amount is going up, of course, over time, because you're basically taking out more money over time, which decreases the equity, which is the value of the home minus basically the loan balance generally. So how to reverse mortgages works continued. The home is the collateral for the reverse mortgage. So clearly, same kind of structure here. You got the reverse mortgage. You're taking money out instead of paying down the loans. You're increasing the loan. The home is representing the collateral to support the loan that's being taken out, which is expected to cover the loan, possibly at the point of death or some other circumstance in the future. So when the homeowner moves or dies, the proceeds from the home's sale go to the lender to repay the reverse mortgage principal, interest, mortgage insurance, and fees. So everything then should be paid off. That's going to be the idea at basically the point of death. Now, obviously, there could be a choice at the point of death. You might say that, they might have the inheritors say that they want to pay off the loan in some other way, which will clearly be more difficult, because at the point of death, the loan will be higher at that point in time. So you'll have this significant loan on it, and you might be forced then at that point, if you didn't have the money to pay off the loan, you'd have to sell the home. Generally, more likely that the home would need to be sold in order to pay off the loan at that point in time. So any sale proceeds past what was borrowed go to the homeowner or the borrower's estate. So you sell the home, you pay off basically the loan, whatever the loan balance is, and if there's any added proceeds, it would go to the homeowner if the homeowner were still alive, or to the estate at that point in time. So reverse mortgage proceeds are not taxable. So you might say, okay, well, if I'm getting money periodically throughout, you might say, well, is that income or not? So when we say taxable, what kind of tax we're talking about? We're usually talking about an income tax. We usually get taxed when we get money. And at this point, you're getting money, but it's not really income because it's kind of like a loan. It's a reverse mortgage. You're increasing the amount of the loan. So it's not something that's going to be taxable, which is nice. So generally, it's not something taxable. So the IRS considers the money to be a loan advance, which is basically what it is, right? You're getting an advance on the loan. It's not like it's income because you got to pay it back. You're going to be paying it back when you die, most likely, if that's how it's been set up, because that's when you're going to have to sell the home and pay it back. So plus interest, right? So types of reverse mortgages. So different types. There are 3 types of reverse mortgages. The most common is the home equity conversion mortgage, or the HECM. The HECM represents almost all of the reverse mortgages lenders offer on home values below $765,600, $600. So that's the one you're probably going to be looking at. So it is the type you're most likely to get. If your home is worth more, you can look into a jumbo reverse mortgage, also called a proprietary reverse mortgage in those instances. So generally, we're looking at the HECM. So then when you take out a reverse mortgage, you can generally choose to receive the proceeds in one of 6 ways. So you're going to say, all right, going into the reverse mortgage, how do I want to get the proceeds from it? And you could choose, how that might be. You might get a lump sum up front. So you might say, I want the money now for a particular thing I'm doing, or possibly I want to make my own investments with it, or something like that. You might have equal monthly payments, which that might be useful if you're thinking of it as kind of a retirement type of situation, and I would like to get my payments monthly over time. Term payments, and we'll talk more about some of these categories in a second here. So term payments, line of credit, equal monthly payments plus a line of credit, term payments plus a line of credit. So let's take a look at those options in more detail. Now, obviously, the lump sum would be you get all the proceeds at once when your loan closes. So you get the proceeds then. This is generally only option that comes with a fixed interest rate. The other 5 generally have adjustable interest rates. So once again, this is the generally only option that comes with a fixed interest rate. The other 5 generally have adjustable interest rates. And that would kind of make sense because the lump sum, you're getting the money at that point. On the other ones, you're getting money as time passes, and interest rates will kind of fluctuate over time. And then the equal monthly payments. So this is the one where you're saying, okay, I'm going to try to get the payments equally over a certain time period, over equal monthly payments going forward, and for as long as at least one borrower lives in the home as a principal residence, the lender makes steady payments to the borrower. Now, note this requires estimates on the lender's side of things because we don't know exactly how long the borrower's going to live, right? So you're doing actuarial, which is like trying to decide, how long someone's going to live calculations, which could add a level of complexity and risk to the lender side of things. So this is also known as a 10-year plan. Then we have the term payments. The lender gives the borrower equal monthly payments for a set period, like 10 years. So this may lower the risk to the lender because now they're saying, look, it's not dependent on how long you live. We're just going to assume possibly you try to calculate or figure how long you're going to live and say, I want payments over a set term, which makes it kind of easier to know exactly what will work out because no matter what happens with you, whether you live or die or whatever, the term is the term, what the term is, right? So you can see the pros and cons of having a term versus having just basically payments go on until the point of death. And you can see what the risks are involved there, because obviously if you live past the term of, say, 10 years or something like that, and you're dependent on those payments, that's a problem. So line of credit. So money is available for the homeowner to borrow as is needed. The homeowner only pays interest on the amount actually borrowed from the line of credit. Now, that could be a situation where you're saying, hey, look, I have all this money in the home. That's my principal, and I don't have a lot of other resources that I'm living on, but maybe I don't need a lot of other things at this point in time, but would like to dip into the equity if I needed to. If I need to dip into the equity, I don't want it to be too substantially difficult for me to do it. I'd like to have the line of credit available. So the line of credit kind of lets you dip into it, similar possibly to a credit card, but having it supported by the home, which possibly allows you to dip into it a bit more easily, and the lender feeling more secure kind of about it. So equal monthly payments plus a line of credit. So you could have a combination of these items. The lender provides steady monthly payments for as long as at least one borrower occupies the home as a principal residence. So you got that scenario, same scenario where we're saying we don't know how long someone's going to live. We're just going to give payments until, as long as someone is there, which means, again, you're doing actuarial calculations. And if the borrower needs more money at any point, they can access the line of credit. So you would think that would be a more, again, more risk to the lender, because now you got these different options they're going to have to kind of figure in these different unknowns, life expectancy, and the other option of being able to dip into the line of credit as needed as well. And then you've got the term payments plus the line of credits, doing this combination thing again. The lender gives borrower equal monthly payments for a set period like 10 years. So now you're not saying until someone dies, you don't have the actuarial calculation kind of thing, but it's for a set period of time. And if the borrower needs more money during or after that term, they can access the line of credit. So then you give them the ability to access the line of credit from that point.